เทส1 2 3 4
Good morning from Bangkok and welcome to Minor International's first quarter's performance review. Today we have the pleasure of having Mr. Chayapat Paitun, Deputy CFO and Strategic Planning, and Mrs. Chithatip Adunpan, Vice President of Investor Relations, who will be giving our presentation today. The aim of today's presentation is to update you on our first quarter of year performance and to share our strategic directions and business outlook for the remainder of the year. I'd now like to hand over to Mr. Chayapat and Mrs. Chithatip for the presentation.
Good morning. We'll start off our agenda with the first quarter performance recap and recent updates, followed by update on Minor Hotel, Minor Food, and Minor Retail Group, and then finish off with the corporate information. We'll start off with the first quarter performance recap and recent updates. Just looking at our first quarter results, we reported revenue of about 16 billion baht in the first quarter of 2016, about 21% up from last year from the normal business, and with the reported financial, it's about 30% increase. It's primarily from both the hotel and the food group business, as well as the revaluation gain from the acquisition of Tivoli, which again demonstrated our abilities to do our acquisitions. In terms of net profit, we reported net profit of about 3.6 billion baht in the first quarter of this year, 66% increase from the same period last year. And if you look at just from core operations, excluding the revaluation gain, it's about 9% increase. So again, both from the restaurant as well as the hotel business. If you look at our international presence today, we are in 32 countries as at the end of the first quarter of 2016. And in the first quarter, 56% of the revenue is actually from Thailand and 44% is outside of Thailand. And we're on our way to our goal of the contribution of 50-50 from Thailand versus overseas over the next 5 years. Just a little bit of update on our investment in our hotel portfolio in Africa. About a week ago, we announced our additional investment in the portfolio in Africa. So these are the Sun International portfolio. So we're actually acquiring the remaining shareholding of Sun in the 8 properties that we currently have our shareholding in. So together, the total investment amount is about 1 billion SAR, or about 2.7 billion baht. That's divided into 2 tranches. The first tranche, which was already completed in the end of 2014, was about 590 million SARs. And the second tranche, which we just announced, which will be completed subsequently within this year and next year, is another 4,431 million SARs. So in terms of the assets that we are acquiring, so today we have 50% shareholding in Royal Livingston, Bayanantra, and Avani Victoria Falls, which are in Zambia. And we're increasing that to 100% shareholding. So we'll be, after the transaction is completed, we'll be wholly owning these 2 properties, and we're expecting that to be completed within the second quarter of this year. And the other 2 properties are in Lesotho and another one in Botswana and Namibia. That will also subsequently come in the second and the third quarter of this year. And the remaining 2 are the ones in Swaziland, which hopefully will get 50% in 2017 onwards. So the reason we're doing this transaction, because it's a transaction following our initial acquisition at the end of 2014, and because we believe in the long-term potential of the region of Africa as a whole, we think that this investment will solidify our presence in Africa, and we'll be able to capitalize on the long-term potential of the region. And we'll also be, of course, using our platform to grow the portfolio further as well. In terms of investment reviews, we've been asked by quite a few investors about the progress of our investments, our past investments, how successful they've been. So we've picked two of our investments that happened about 4 or 5 years ago, so that there's a good enough track record to show you of the progress. The first one is Oaks. If you remember, that was done in 2011 with the investment amount of about 84.5 million Aussie dollars. With that project, the project's actually been paid back within 3 years, and the IRR is above 15%, which is above our hurdle rate. If you look at in terms of growth, revenue has increased by about 10% over the past 4 years in terms of CAGR. And in terms of the development, we've actually added over 20 properties, which means over 1,500 rooms over the past 5 years. We've also diversified Oaks brand outside of its home country, which is Australia. Now we also have them in Asia as well as in Middle East. And we have developed new product offering from just doing traditional management letting rights in Australia to hotel management contract as well. On the food side, we picked Minor DKL, which is our investment in Australia. Initially, we invested about 23 million Aussie dollars in 2008. The payback period of this deal is actually about 5 years, and the project IRR is over 25%. In terms of revenue, we've seen a CAGR growth of about 24% over the past 6 years, and we've expanded from a single brand acquisition with just the coffee club. Today, we have a portfolio of 6 brands, and we grew a number of outlets by over 60% over the past 5 years, and also increased the international footprint from just in Australia. Now we also have the outlets in 7 other countries across Asia and Oceania as well. Now, a little bit going into each of the business group. We'll start off with the Minor Hotel Group. If you look at financial performance, revenue actually increased by about 18% in the first quarter of this year compared to last year. So each of the categories actually seen revenue increases. Owned hotels, the revenue grew by 25% year on year, primarily because of the hotel business in Thailand, as well as the newly acquired hotels, which is the acquisition of the Tivoli hotels. Oaks, we've seen revenue increase of 8%, so that's pretty much in line with the RevPAR increase over the past quarter. Management contracts, we've also seen revenue increase of about 12%. And real estate, we've seen 20% growth, primarily from the sale of the Phuket in the Layan residential units. In terms of EBITDA, it's actually grown by about 24%, and net profit was up 10%. You look at our international presence in terms of the hotel business alone. In the first quarter of this year, we had revenue from Thailand of about 45% and from overseas of 55%. So we're still targeting for the next 5 years to see a decline in revenue from Thailand and more outside of Thailand to about 66%. Going a little bit into the stats of the hotel operations, system-wide rooms actually increased by about 13% in the first quarter of this year compared to first quarter of last year. Occupancy for the system was down by about 2%, whereas ADR was up 1%. So RevPAR on a system-wide basis was down by 2%. But if we exclude the new hotels, which is primarily Tivoli hotels in Portugal, and also the newly opened Avani Riverside in Bangkok, then organic RevPAR excluding foreign exchange impact operationally, we actually saw a RevPAR growth of about 6%. If you go into a little bit of detail on each of the category for our hotel business, the first one is owned hotels, which is today about 55% of total hospitality revenues. It's grown a bit from last year, primarily because of the acquisition of Tivoli that came in February of this year. If you look at it in terms of number of rooms, it's added about 37% to our rooms compared to the same period last year. Occupancy for owned hotels, again, down by about 10% because of the addition of these Tivoli hotels. Especially first quarter in Portugal is also low season, so of course the occupancy was lower than our average portfolio in the first quarter. ADR was down 11%, so RevPAR is down 24%. But if we exclude the new hotels, then organic RevPAR, excluding foreign exchange impact, still increased by about 5%. So that's primarily from hotels in Thailand as well as Oaks in Australia. Even if the RevPAR was down by about 24%, but because of the incremental revenues that came in from Tivoli, the revenue of owned hotels still increased by about 24% in the first quarter of this year. Now we divide the owned hotels into Thailand and overseas. If you look at our Thailand portfolio, it contributes about 34% of the total hospitality revenues. So owned hotels in Thailand is still one of the biggest component for our hospitality business today. If you look at in Bangkok, RevPAR was in the first quarter was down by 3%, but that's because we've opened new hotel in the Avani Riverside here in Bangkok. If we exclude that, then Bangkok RevPAR actually increased by 2%, so still a growth for Bangkok hotels. And in the provinces, we actually saw RevPAR increase up 11%, so continue to be resilient in the provinces. And we've seen RevPAR increase in pretty much all key tourist destinations, Phuket, Samui, Hua Hin, as well as Chiang Mai. Now, if we go into overseas owned hotels, which is about 20% of our hospitality business, again, we saw a RevPAR decline of about 47% because of the Tivoli acquisition. But if we exclude Tivoli portfolio, then overseas owned hotels RevPAR declined by about 8% year on year. In this quarter, we also tried to break down for you in terms of revenue contribution from overseas. So the biggest markets for us are Maldives, Brazil, Portugal, and Africa. So we'll just go into each of these markets in a little bit of detail so you understand the trend for each of the markets. In the Maldives, we're still seeing slight improvement, both in terms of RevPAR as well as revenue growth and net profit growth for the Maldives in the first quarter of this year. In Brazil, we've seen RevPAR decline in the first quarter, primarily of two reasons. One is because both of the hotels were under renovation in the first quarter of this year, both in Sao Paulo as well as in Bahia. And also because of the weakening of the Brazilian reals as well. But in any case, we still saw revenue increase in Brazil for us by 31% because we've consolidated 2 months of Brazil operations last year versus the full consolidation of the whole quarter this year. In Portugal, we've only recorded 2 months of revenue in the first quarter of this year because we've acquired the portfolio in February of this year. And also, first quarter is a low season for Portugal. So contribution from Portugal will be higher in the second and the third quarter onwards when they go into the high season of Portugal. In Africa, today we have 2 hotels which are categorized as owned. One is Botswana and one is Namibia. Those 2 hotels are more like city hotels, so they were impacted by the regional economic slowdown of Africa as a whole. But once we've completed the Sun International transaction that we announced last week, then then we'll have Zambia as part of the consolidated revenues from Africa as well. And Zambia is more sort of like leisure hotels, because they're next to the Victoria Falls. So it's more of the tourist destination, and they'll be less susceptible to the regional economy. Plus, we've just finished the renovation of these hotels, so their rates are expected to be improved, as well as the overall operations, and they'll have more operating leverage as well. For Oak's operation, which is about 20% of the hospitality revenues today, we've seen about flattish in terms of number of rooms growth. Occupancy is up 2%, ADR is up about 6 to 7%, and RevPAR is up about 9%. So revenue for Oaks is also up by about 8%, in line with the RevPAR increase. And this quarter, we don't have any, Australian dollars didn't weaken against Thai baht, so it's been stable in terms of the currency in Australia for us as well. For management contracts, which is about 4% of our hospitality revenues, we've seen room growth of about 8%, as well as RevPAR growth of about 8%, primarily from hotels in UAE as well as in Thailand. So in terms of revenue growth, they're about 12% in line with the operations. This is the hotel expansion pipeline. So we have hotel investment on the left-hand side and management contracts on the right-hand side. So over the next 3 to 4 years, we're adding 14 hotels in terms of hotel investment, about 2,600 rooms. And in terms of for management contracts, we're adding 28 hotels, about 4,500 rooms over the next 3 to 4 years. So that's pretty much in line. On track, we should be. Most of the owned hotels have actually been opened, with the exception of the Sri Lanka and India ones. Everything else is pretty much through the acquisition of Tivoli, as well as the Avani Riverside has been opened already. A little bit update on the real estate business, which is about 18% of the hospitality revenues. So for the Residences by Anantara Layan, we've launched that project about the second half of last year. So in fourth quarter, we sold 3 units, and in first quarter of this year, the momentum continued, and we were able to sell another 2 units. So now we've sold 5 units out of the 15 that we have. As of today, we've completed about 8 units in terms of construction, and the remaining 7 will be completed by the middle of this year. So in the second half of the year, we'll have the entire pool of inventory available for sale. And the last business on the hotel side is in Anantara Vacation Club. So in terms of number of members, we're still growing. In the first quarter, we have about 7,200 members, which is about 23% growth compared to the first quarter of last year. And the main drivers, the main nationalities continue to be China, Thailand, Singapore, and as well as Hong Kong. We have changed the business model of Anantara Vacation Club a bit in the second half of last year. So the package is now smaller, but we're trying to bring the cash flow forward as well. So we've increased the initial investment, as well as shortened the loan, so that also helps with the lower bad debt, as well as lower cancellation rate. With that, we've seen a little bit of pressure on both the revenue as well as the profitability of the business, but this will be temporary, and by the end of the year, we should start to see the business back to normal again. So now I'd like to turn to Kunchayapat for update on Minor Food Group.
Okay. For our restaurant business, maybe I'll start off with a recap of financial performance of Minor Food. Total restaurant sales grew by 28% year-on-year as a result of both revenue from operation and also from franchise fee. Revenue from operation increased on the back of a strong performance of our Thailand and China hub, and probably as a result of our disciplined expansion, our equity outlets as well, and also the consolidation of Minor DKL, our subsidiary in Australia. We increased the stakeholding in there from 50% to 70% since November of last year. So we consolidated that since then, and in the first quarter we have full consolidation of that subsidiary. Franchise fee also grew significantly as well on the back of the strong performance of the pizza company, as well as the consolidation of Minor DKL. As we mentioned to you in the previous quarter, Minor DKL, or our Australia hubs, are pretty strong and put a lot of emphasis on expanding franchise businesses in that region. So that's why we saw a significant increase in franchise income on consolidated basis. But even if we strip out the effect of Minor DKL consolidation, we still see revenue and profit of Minor Food growing year on year still. Revenue grew by, like I said, 28%, EBITDA 26%, and net profit of Minor Food grew by 12% year on year. If you look at total system sales, we achieved about 8.8%, led by the pizza company, Burger King, and Riverside, and for outlet expansion, up 8% for the group as a whole. The one that show aggressive or active expansion were Burger King, Riverside, Bread Talk, and our outlets at the airport through SSP, as well as the pizza company. Same-store sales growth, however, came in at 0.9%. Well, look moderate, but still relatively resilient, considering that we're still in the middle of a slowdown in economic backdrop in consumption, both in Thailand and Singapore. In fact, Thailand has shown us very strong performance, which I will explain to you later on the back of our leading market position that we have over here. Next slide, we show you our international footprint. Right now, we operate our restaurants in 19 countries across the region, both under equity-owned and franchise business model. So we look to expand more. Right now, our revenue contribution from overseas account for about 38% in the first quarter of this year, while the remaining 62% coming from Thailand. And currently, we operate under four hubs: Thailand, Singapore, China, and Australia. And going forward, we're probably going to have more new international hubs once the contribution of those new hubs, potential new hubs, coming on stream more significantly. The potential one include the UAE or the Middle East, as well as India. Let's look at the operating statistics of the restaurants. Total system sales grew by 8.8%, like I said, on the back of outlet expansion of 8%, primarily from expansion in Thailand and Vietnam, as well as same-store sales growth of 0.9%. 0.9% was primarily driven by Thailand and China hub solid performance. Thailand, we have a leading market position, so we still become resilient to any disruption or slowdown in macro backdrop. And if you look at our number of outlets right now, the number of outlets stood at 1,859 outlets at the end of the first quarter, split 64% in Thailand and 36% in international. And if we split between franchise and own, it's roughly half-half, 48 franchise and 52 own. And we have an aspiration to increase the number of outlets from 1,859 to more than 3,000 in the year 2020, as per our 5-year plan. Now we look at the hub one by one. Start off with the Thailand hub, which account for the majority of our revenue. The Thailand hub on the restaurant side account for about 62% of our restaurant revenue. So the pizza company and Burger King were star performer in the first quarter, reporting strong same-store sales growth. And also, if you look at the promotion, marketing, or strategies that we adopt, the successful tactical initiatives, product innovations, together with effective marketing and promotional campaigns, help us achieve such a successful results. In the first quarter, the crispy thin pizza and the menu, new menu items, dine-in items in the pizza company start to also continue to put strong momentum in the sales for pizza company, as well as the BOGO campaign or buy one get one free campaign that we have for the pizza company in the first quarter of this year also was also very successful. For other brands, Swenson's was a little bit slow at the beginning of the quarter, but at the end of the quarter we put in effective new mango promotion with new flavors, as well as we put in a solid marketing plans for the rest of the year. So we hope that the results of the performance of Swenson's will improve throughout the remainder of the year. Sizzler, we also come up with innovative product offering. So we have a new product offered to our customer in May. So it's Dairy Queen. We have tried to modify our product offering as well to attract more traffic. For Burger King, we apart from focusing on tourists as customers, we also capture Thai or local customers here. So we have open outlets in Bangkok, outskirts of Bangkok, and other major cities, as well as drive-through, and also we put in a new format in the gas stations as well. So that's drive sales of Burger King quite impressively. Next hub is Singapore hub, which account for about 10% of our total restaurant revenue. Singapore is still experiencing economic slowdown and intensifying competition in the market. So since last year, since the second half of last year, we took the opportunity of the slowdown and macro backdrop to cease our operation temporarily and implement what we call Reborn project. We're renovating, we're upgrading the decor, design of our outlets or our flagship outlets in Singapore, as well as improve the quality of the menu, quality of the food, as well as staff productivity to overhaul and revamp our Singapore operations. So that's result in the slowdown sales. So that's why we saw negative same-store sales growth since last year up until now. But if you look at the trend, although same-store sales growth remained negative in the first quarter, the trend is improving with the best same-store sales in the first quarter since the beginning of 2015. Total system sales also continued to be negative because of the pause in expansion, like I said. But we're trying to, the whole program comprised 15 outlets renovation altogether. We have done roughly 4 to 5 outlets since last year up until now, and we will do with the remaining outlets throughout the rest of the year. And we also implement some initiatives in Singapore. We put in or launch our Thai Express outlets called Thai Kitchen by Thai Express in Food Republic or Bread Talks Food Atrium concept, our strategic partner in Singapore. That's amplify the synergy that we have with our strategic partner. And we also launched a new Riverside restaurant, the brand that we have in China. We introduced it outside of China in Singapore. This is the very first outlet that we introduced in Singapore, just to see how the reception is in this market. Next hub is Australia. Australia contribution increased quite significantly to 14% of total restaurant revenue this quarter with the consolidation of Minor DKL, or our subsidiary in Australia, as opposed to the recognition of equity income in the previous years. So since we increased our stakeholding in the company from 50 to 70%, we consolidated the account since November of last year. If you look at same-store sales growth of Australia, hub is pretty much stable and pretty much flattish, and we consider it's quite satisfactory already in the middle of the slowdown in the economy, especially in Queensland, where we have half of outlets located over there. In terms of total system sales, it grew by 2.2%, since we still cautiously expanding in limited of the softening macro backdrop in the country as well. If you look at our effort to improve the profitability in Australia hubs, we continue to implement the vertical integration after we have acquired Veneziano. We have successfully integrated Veneziano into our Australia hub, and we will continue to further enhance the supply chain of coffee roasting or the coffee beans that we have from Veneziano across Mint global supply chain to further drive profitability in the future. If you look at Australia, even though total system sales growth slow to only 2.2%, but net profit from operations still increase satisfactorily because of the proceeds from sales of some of the store to our franchisee as part of franchise business, which still yield good growth in terms of profit at our Australian hubs. For China hub, last hubs that we have on the restaurant side, it accounts for about 13% of total restaurant revenue. China hub reported a remarkable turnaround with positive same-store sales growth for the first time in 2 years in this quarter. So we remain confident about the middle class and growing middle class and urbanization in China. If you look at our expansion plan, we continue to expand in China, especially in Beijing, where it's only marginally or minimally linked with manufacturing or the slowdown that people talk about China as a whole. So Beijing is pretty much on the food consumption, we see it's pretty much resilient compared with other cities in China. So we will continue to concentrate our expansion over there, while we'll also look out for other cities to expand, but with a cautious manner. If you look at the Riverside, apart from expanding more outlets, we also trying to control costs. We integrate back office of Riverside into our original China office, Minor Food Group China, and we implemented cost control, including raw material costs, labor costs, and shop expenses. That will likely lead us to see improving profitability throughout the rest of the year. So that's the wrap for minor food or restaurant business. Now I'm just going to touch a little bit on minor retail. Minor retail still account for a very small contribution to our revenue, account for only 7% of our total revenue and 2% of our net profit. In the first quarter, revenue of minor retail increased by 4% on the back of recovery of both fashion and manufacturing businesses, especially when there's a sales promotion on the fashion side. But at the profit level, or at the EBITDA and net profit, we still report decline net profit because of the promotional discounts that we gave of previous season inventory, as well as higher marketing and promotional costs that we try to push for existing brands and also introducing the new brands that we launch into the market. If you follow us closely, in the second quarter of this year, we have selectively added 2 new brands in minor retail portfolio. We introduced Brooks Brothers to Thailand, as well as Kojima Premium Denim in Thailand. So going forward, we as minor retail will continue to restructure our portfolio of brands to drive revenue and profitability. Next slide is just to show you statistics of minor retail. Same-store sales growth showing an improving trend, not deep negative like before, but in this quarter it's pretty much flattish. And also total system sales grew to positive territory, about 4.2%. And if you look at productivity measured by sales per square meter, we see improvement in sales per square meter quarter-on-quarter and year-on-year as well. Now, Let me touch a little bit on corporate information, especially balance sheet and capital expenditure that we're going to have over the next few years. As per our 5-year plan, which hasn't changed much from what I reported to you last quarter, we still have capital expenditure of approximately 40 to 43 billion baht to spend over the next 5 years. This amount will be split into committed capex and new investment capex. Committed capex will hover around 28-29 billion, and new investment capex will hover around 14 to 15 billion. So that's going to be spent across the years throughout 2020, with the majority expect to be spent on hotel group because of its capital intensive nature. If you look at leverage ratio, our leverage ratio or gross interest bearing debt to equity at the end of first quarter hover around 1.28 times, still below our internal policy level 1.3 and our debt covenant level 1.75. The reason it's still stay almost touch our internal policy level because we have spent on the acquisition, especially with Tivoli that just happened in the first quarter, the completion of Tivoli portfolio which happened. But the earnings contribution of Tivoli has not yet come through to feed through to our results as yet. Once that happen, it will bring down leverage ratio over time going forward. And also the backup financing that we have, apart from unutilized loan and borrowing facilities of more than 27-28 billion baht, we still have warrants waiting to be exercised, the ones which as we speak now in the money, and will provide us with the proceeds of 7 to 8 billion baht in the year 2017. So that's enough and sufficient for our future expansion. 5-year aspirations. As per our 5-year plan, we want to see our number of hotels increase from 147 hotels to more than 200 hotels by the year 2020, which we think that it's not hard to achieve. Restaurant from 1,800 restaurants now to more than 3,000 restaurants by the year 2020 as well as retail point of sales and shops to more than 360 retail shops in the next 5 years as per our 5-year plan. So let me wrap up by recapping our 5-year strategy very quickly. Our goals still remain that we want to see net profit growth on a CAGR basis over the next 5 years, no less than 15 to 20% per annum on average, and return on invested capital of no less than 15% over the next 5 years. In order to achieve these two goals, we have 3 strategic pillars. We're trying to drive our portfolio of our own brands going forward with additional contribution from selected international brands that we have, both on the hotel side and restaurant side. But we'll put more emphasis on our own brands, which yield us with higher margin and higher return. As well as a second pillar, we're trying to maximize asset value and productivity of our assets, be it asset refresh, asset renovation, asset light model, or mixed use initiatives like residential and timeshare, which can heighten return of the overall project. We're trying to look out for this opportunity to enhance return overall for the company. And lastly, we will continue to look out for future strategic investment and M&A or acquisition still. But having said that, we will try to focus on organic or the acquisition that we have already made, make sure that they yield satisfactory results or the results that we expected right before the acquisitions. Just make sure that organic and inorganic hand in hand will help drive the growth of our company in unison. So that's the wrap of our first quarter 2016 presentation. Now we open for a couple of questions. If you have, you can send us online. The question is, the first question, what is the season of Tivoli hotels in Portugal?
So first quarter and fourth quarter are low season in Portugal. So in terms of occupancy, it could be as low as like between 40 to 50%. High season will be the second and the third quarter. In the third quarter, it could get up to as high as almost 90% occupancy for Portugal.
So we'll see high season in second, third quarter, but third quarter, the weight will be in the third quarter rather than the second quarter. Second question, what is the performance of restaurants in upcountry versus Bangkok of Thailand? I think we see the stats like same-store sales growth of upcountry better than Bangkok this past quarter. So that's what we've seen in the first quarter of this year.
Yeah, so the trend is because for the past 2 years we've seen negative growth for upcountry. So also part of it is reason is also because it was probably from low base. So this year we're seeing better improvement in the upcountry. Whereas in Bangkok we've also seen quite a few major renovations in many of the major malls in Bangkok. So of course that caused the traffic slowdown in the major malls in Bangkok as well.
I think that's the question we have for now. But if you have additional questions, since we're tight of time, if you have additional question or you want us to address, please do not hesitate to send to our investor relations divisions of the company. We'll try to respond to your question as soon as we can. So today, thank you very much.